So now we pivot to Europe and the issues that are over there. But it's interesting because when you look at some of the dynamics, the data's gotten worse, or I should say it's gotten slightly better, but is staying in contraction. And that's something that we're expecting, where you have this big downdraft and then you kind of bump sideways, maybe get a slight improvement before you get your next leg down. And that's what we're seeing right now. And that's why, things flatlined a bit for data, and now we do expect it to worsen next year. But again, there's a certain amount of stability that happens in the near term. So obviously, as we said before, the ECB raised rates, in line with estimates. There was no surprise there. Eurozone manufacturing PMI was expected at 47.1, came in at 47.8. Services was expected at 48.5, came in at 49.1. So the composite was slightly better than estimates, 48.8, still in contraction, but just kind of meandering around this point of 47.5, 48.5. You're kind of just, you're declining just at a slower rate. Trade, when you look at CPI, slightly higher than expected on the year over year, right in line month on month. So labor costs came down, still positive. Construction output, fairly flat, but that was October. We know it gets a bit worse in November. So the consumer confidence expected at negative 22 came in at negative 22.2. But in November, it was negative 23.9. So again, you're just kind of bumping along as the market takes in the fact that they're in a recession, that things are slowing, and how do you kind of manage where things are and what some of those limitations may be as we go into the next quarter. So it's not surprising to see that the real GDP, though, is interesting, because for 2023, the ECB is still expecting growth. I don't have much to say on that. I look at that, and Barclays is at negative 0.8. I mean, in 2023, it's going to be difficult to eke out growth given the problems that exist from the Russia situation. There's comments on how Russia's going to sign on some response to the price cap. How is that going to shift? Where are those pressures going to be? I don't see a lot of good things with Europe, which is why I'd safely say Barclays is probably right. If I had to go higher, I'd say closer to about negative, a negative 1.2, negative 1.3%. And that's where I think you're seeing some of this over exaggeration. And even on the 2024 side, everyone is expecting this big jump. And based on demographics, based on underlying, not demographics, inflation, supply chain rates, I agree with Barclays again. I don't, you'll get a bump. I'm by no means saying that you're going to get this massive decline, but I mean, 1.9%, that's aggressive for where things are right now. Just this looking at the ECB side, but even though things came in line, the governing council wanted to go with 75 basis points on the hawk side, but a compromise was struck to deliver hawkish guidance on rates and quantitative tightening. So some people wanted 75, but they said, look, we'll do 50, but quantitative tightening is there and we're going to continue to raise. So the market now sees the terminal rate above 3%. And you can get an idea how that is a surprise to the upside, and that's when we see some of these different issues in general, and why we see more upside. Realistically, we think the ECB is going to have to get something closer to 3.5% over the next few months. Eurozone consumer confidence, just to give you an idea, it did bounce, but you're still at the lows that we have seen in 2020, as well as 2008. And then German producer price index, industrial products, that's kind of that, again, that breakdown where, sure, PPI has come down, but even coming down, it's still, more than triple what it was it's going back to 1998. So this it's getting better versus the highs, but it is not getting better versus historic. So again, there's still a ton of downside that has to happen But in the meantime, as it stays up here, and there's stability when you look at where natural gas is, where LNG is, where electricity prices are, where a lot of these things are going to be fairly sticky. So then when you look at the ECB having more ground to cover for 2023 in terms of some of those projections, there's the projections have shifted higher, which is why the real GDP, which again, this is from the perspective of ECB, which we think that real GDP goes negative. There's a lot of reasons why rates are going to have to stay elevated because there's a lot of wood to chop on inflation. The ECB sees the labor market continuing to run hot, which again, back to our conversations we had in segment 1, in segment 3, there is a demographic problem. We are losing people who are of working age, who can work. So the labor force is going to remain tight, even though you get weakness, even though you're going to get layoffs and you're going to get essentially job openings come down. There's still that demographic issue, which is going to keep wages elevated and some of those prices stronger. Eurozone composite PMI, again, putting into context. But then when you take the composite PMI versus GDP, you get an idea that, look, there's still a lot of downside when you look at that GDP revision and why we see more pressure quarter on quarter, year on year. Input prices coming down, but when you go back through 2016, we're right back to where we were in 2020, 2021, and it's still a problem, which is why inflation can get better, but it's more disinflation. It's just the rate of change of inflation has slowed, not inflation itself. We haven't gone from inflation to deflation, but a lot of staying power on the stagflationary backdrop. Germany wholesale prices came down for 0.9, but as we showed earlier, it's still massively higher versus any time in history. German manufacturing expected at 46.3, came in at 47.4. Services better, expected at 46.3, came in at 49. So the composite beat estimates by a nice margin to 48.9. Still in contraction, but still a nice bounce, and why we see some of that stabilizing into year end, where we do think there's going to be a bigger drop off. Business climate expected at 87.5, came in at 88.6. And then the current assessment expectations also beat expectations, but still, in a contractionary standpoint, PPI slightly bigger drop than expected of 3.9. But then you look at consumer confidence, expected at negative 38, came in at negative 37.8. So still, again, there's still hesitancy, there's still concern, but not as bad as it was. So that's when you start looking at why we see some of that additional downside and some of the surprise to the downside as we get into next year. Now, France, slightly different backdrop. CPI still going up, just at a slower rate. When you look at business confidence, kind of right in line with expectations in prior. Same with manufacturing conditions. Production outlook indicator, still negative. And then you look at composites PMI, it's having a bit of a reversal. So composite PMI was expected at 48.7, came in at 48. Manufacturing slightly better, expected at 48, came in at 48.9. Services expected at 49, came in at 48.1. So Germany and France are Germany got much worse, much faster, now a little bit better. France stayed better longer, now worsening a bit. So they're kind of working in tandem, and these are the two biggest economies in the EU, and why it matters so much when you start looking forward to where that growth or lack thereof would originate. Expectations for Germany, again, bouncing, but then you break it down to manufacturing, service, trade, construction. All of the expectations are still negative. It's just they're less negative than before, but there's still an underlying problem when you look at what is going to come next year, which is why we still see more of that downside, especially with consumer confidence. It bounced, but going back to 2006, it's still the worst it's ever been, worse than 2020 in COVID. So then when you look at 60% of German companies complaining about supply shortages, it's obviously much better than it was. But going back to 2009, that's still, what is that? That's still 30% more than ever before. So even though things have gotten better, they're still bad. They're just less bad, which is, again, still not showing any kind of growth, which is something that we think is gonna continue to resonate through the area. Germany manufacturing, you get an idea of the bump. So you get an idea how things are just kind of stabilizing, which is why we see, again, lower high and then a move back down, especially when you start looking at France in terms of kind of that stabilization. But there's still a lot of that down move as you start looking at how it relates to GDP growth and how it's going to pull things down. And there's still a lot of movement to the downside, given where the composite output index is. Output is still negative when you look at Germany. Output is now negative in France. So composite output index, what is to come, is showing you that the leading indicators are negative. And a lot of this is going to pull GDP growth down with it so that it comes into contraction, which is why we see this getting much worse as we get into Q1, or I should say getting worse again, because right now we're kind of flatlining, slightly better, slightly worse in some areas, still in contraction, but the contraction is going to accelerate next year. So that's what we have for you on Europe. In the next segment, we're going to look at China and Asia in general and some of the key leading indicators that we've seen so far as we look out into next quarter.